Hello, Andrew.
Hi there.
How are you?
I'm very good, thank you. I'm very good.
For those of you who listen, thank you very much for joining us. With me is Andrew Hollingworth from Holland Advisors, and we're going to dive deep into his life, work, and philosophy of investment. Holland Advisors have a fund that is a UCIT, which is very nice. It's open to the public, manage around 400 million pound, right? Am I correct?
Not quite as much as that, no. We're about 100 million currently, but
Oh,
we'll be at 400 million, I'm sure, by the end of
no,
this
I don't know what
podcast.
I said. I thought 80, but 100. All right, great.
No.
And tell us a little bit about yourself, Andrew. Let's start from the beginning. When did you start being interested in investing?
So I'm born in 69, so I'm 56 today. I was a teenager during the sort of Maggie Thatcher heyday. So in the sort of 1980s, 85, 86 sort of period of time, there was a lot of privatizations in the UK. So the stock market was on the TV a lot. It was a big sort of prominent sort of privatization type period of time. And I'm dyslexic. I was okay at school, but I was good at maths and that sort of stuff, but not very good at English and all that sort of stuff. And so I knew I wanted to do something in business, but I didn't know what it was. And my father ran a hardware store and said, well, you could become a bank manager or an estate agent, and they didn't sound very interesting. And so I thought, well, let's go and try and work in the stock market. And that's how it started. And I didn't go to university. I just joined a local business, did a year's work experience with them, and then I joined a company called Henderson, which is now the sort of Henderson Big Fund Management Company, and I joined them full time in the summer of 1987, and the stock market crash in the October 1987 was 10 weeks later. So I had a real
What a
baptism of
start.
fire, and it was a hell of a way to start a career. And people either remember or have read about the stock market crash in 1987, but they don't realize what came next. And what came next was a 1990, 1991 recession. It was a really tough period to be in financial services in London. So yeah, I learned the right way or the hard way, depending on your definition.
It's such a difference the time that you start. Such a
Absolutely.
but to start in '87, there not a lot of fund managers were there back then. Fund managers that are
Yeah.
working today were active in '87.
Yeah.
What was it like?
Um, Well, I didn't the boom of '87 I didn't really experience because I was so young. I was only 18, and as I said, by the time I'd worked out where the office was, we'd had a crash. And the period after the crash was really interesting. I mean, we Henderson I was working for was a big fund management company. They had like 800 members of staff. They'd grown really quickly, so they had like 150 temporary members of staff. They fired them all in one day. I mean,
Wow.
literally, the week after the stock market crashed, we went from 750 people to 600
Maybe
in a
give
day.
some info to people who are not familiar with the 1987 crash. Tell us what was the crash, because I don't think it's a lot of people. I mean, '99 is more famous, and 2008 is
Yeah,
a lot of people
yeah,
still remember. What happened in
yeah.
1987?
Well, 987, the stock market just went up a lot in the course of the year of 1980, late 86 and 1987. And on the Monday morning, it fell something like 18, 19% or something, London and America. And I was working on next to the sort of, I was very junior, but working next to the head dealer at the time. And he got all of us youngsters around his desk, and it was the end of the Monday, and it had been a really stressful day, and there was lots going on that I didn't necessarily understand. And he got us all around his desk, and he said, "Look, you're all very young. You've not seen this much before. You need to understand that in the whole of your careers, you will never see the stock market fall more than this in one day, because it had fallen whatever it was, I forget, 12%, 15%, whatever it was." And so he said, "You'll never see the stock market fall as much as this in one day in the whole of your careers." The next day, it fell more. And that's
Wow.
just a stat that's like, so you've got a guy that's my age now who's sort of like a seasoned professional telling everyone how to do it, and he didn't have any idea. And yeah, and it was a big period of time, and a lot of people that had got pulled into the stock market in the 1980s, and there wasn't circuit breakers that happen now. So you saw a sort of 2007, 8 type fall, but it didn't happen over 9 months. It happened in 4 days.
Wow.
And yeah, and that changed a lot of people. And so you didn't have chance to go, oh, there's a circuit breaker. People have
How
stopped
long did
shorting. I
it
think
take
I'll do this
it?
tomorrow. It's 2 days. Yeah.
How long did it take for it to correct itself back?
Quite a while. I can't remember. I mean, we're talking a few years, maybe
Wow.
5 years, 10, 7 years. I can't remember, but it was a really big. So it was. So everyone talks about 99 and 2008 as being like 1929, and they sort of were in the sense that the sort of scale of the events that preceded them. But by way of a crash that happened very, very quickly, 87 was really severe, and your portfolio was literally down 30% in a week. I mean, there was no question, and there was nowhere to hide it, and it was indiscriminate in that sense.
I think that
So it was really
today,
interesting.
people who start investing in the last decade, I think one of the big challenges is they don't understand what does it mean a crash, because for them a crash is
Yeah,
something that happened and corrected 1 month later, like
correct. Yeah,
2020 or
yeah,
2022.
yeah,
It's like, oh my god, few
yeah,
months, and then everything goes back and you continue gaining, so it's
yeah,
okay. They
yeah.
don't understand what it means that it will take a few years to get back your
Correct,
losses. And
correct,
so they
correct.
allow themselves to fully invest in the stock market, like a lot of money, and it's
I
very,
think that's absolutely
very.
right. And we've had a lot of, I mean, 2008 was a pretty severe downturn, but we've had a lot of bailouts. We've had a lot of stock market goes down, Fed cuts interest rates, prints money, COVID. There's a lot of periods of time where the stock market has gone down, for a period of time and then has quickly recovered. And we haven't had, outside maybe 2008, a period of time where the stock market's gone down quite a long way and has not recovered, and the psychology has taken a long time to recover. And you saw that a bit of that happened in 99, which we might come on to talk about. A bit of that did happen in 08, and it definitely happened in 87. So yeah, it's I've lived through a few of them now. I've lived through maybe a few more than I
So
would have liked, but
we're
yeah, you
gonna
learn a lot along the
go
way.
in the next chapters of our conversation. We're gonna go deep about what's happening now in the stock market. So I
Yeah,
think
sure.
your insight from all those crashes is going to be very interesting. But let's go on with your life story. So how did your career took path from there?
Yeah, so I started very junior in 1987. I didn't have a degree. While I was working at Henderson, I did all my analyst exams. So your sort of, I forget what they're called in the States now, but the CFA exams. So I did
Hmm.
the equivalent of the CFA exam. So that's how I earned my profession, if you like. I then worked at another internal pension fund for a couple of years, a British Gas internal pension fund. And then I joined a company called Smith Newcourt. And Smith Newcourt was then a really well-respected, big, powerful market-making, stockbroking company in London that was then ultimately bought by Merrill Lynch. So I
Hmm.
worked for Smith Newcourt for a year, and then it was bought by Merrill Lynch, and I worked for the combination of those two for about 10 years. And that was a big period of my life because I then was a telecom specialist sort of analyst. I was a telco specialist analyst right at the top of the market, 99, 2000.
Wow.
And then I became a generalist where I came up with all sorts of ideas of my own. But yeah, that was a big period of my life where I learned just absolutely just vast amounts about analysis, yeah, business models, yeah, but also about market psychology as well. And then other stuff has come on from that. But yeah, that I did that. Merrill's became a bit corporate, a bit sort of American investment banking, and stopped allowing us how to do our jobs how we thought. So I left to go to a startup firm called Redburn, who wrote independent research, and I did 5 years for them, which was a perfectly good firm. And then I set up on my own, and I come from a family of self-employed sort of entrepreneurs, and I just set up my own business maybe 20 odd years ago now, whatever it was, yeah. And originally wrote investment research, which a lot of it you can still see on the website today. And then about whatever it was, 16 years ago or so now, we set the fund up. And so now all we do is run the fund. Whereas there was a period of time when I wrote research and ran the fund, and now any research we send for free, just for fun and for informative purposes. But but
When
but the process of running the fund has been a one that we've sort of gradually got to. I didn't leave university and think I deserve to be a hedge fund manager. It really, really wasn't like that. It was the opposite. It was just the fact that I gradually got to various jobs, and someone said, "Well, why don't you run a fund? Why can't I give you my money?" And in the end, that's how it came about 20 years ago. As
but
I just
you
went,
consider
"Yeah, okay, I'll do
yourself
that."
as a value investor, right?
I do. I mean, I'm a massive Buffett fan. I've been to, in fact, even behind me, I think you can see poor Charlie's Almanac there. Um, And actually, the picture on the wall, that one there, if you can see it, that came from Berkshire Hathaway. I bought it when I was there. But yeah, I'm
So
a massive
when
Buffett
was
fan.
it
But
that
I
you...
like compounding at a good. So I like growth, but I like it at the right price.
Okay, but when was it that you... Because I think all the institutions that you discussed, that you worked throughout your career, are not really value on the various kind of way of thinking. So how come you end up being a value investor?
Great question. Great question. So because I think, to someone that comes into the industry today and they join Fidelity or someone like that, and they get a training scheme and they get books to read and they get mentors and all the rest of it, that didn't happen to me at all. I mean, literally at all. So I arrived, I get given a telephone and a spreadsheet, and I just start trying to work my way through the investment world. And a lot of people do enter the investment world like that without realizing it in sort of sales type functions. And so I was I was Mr. Market. I was a sort of busy fool. I was running around doing lots of different ideas. And I came across Buffett and Munger maybe in my mid to late 20s, maybe mid 20s. And I started to go, well, hang on a minute, this is the way to do this job. And really from maybe about 26 onwards, I was working my way towards becoming independent, if you like. So I was saving my money from the bonuses I was being paid from the job I was doing. I was learning how to do the job sort of from first principles. And that became a big teaching for me. So a lot of people say to me, oh, well, who was your mentor? Which fund manager did you train under? And I didn't. My mentors were Buffett, Munger, Klarman, Phil Fisher, Peter Lynch, all the people that I've studied in the last sort of 30 years or so. And then the more I did that, your observation is absolutely right. The more it became relevant to me that the stockbroking companies I was working for were completely the wrong place for me to work. Because
Why
they
is
were all
that?
about 6 ideas in the morning and another idea at lunchtime. And it's like, no, that's not the point. The whole point is we want to own 20 stocks and own them for 20 years. We don't want to be changing our mind every 5 minutes. So that's why I left, and that's why I set up on my own, because I realized
I
that I
think it's
was
a very
inappropriate.
important point that I would like to double click on and to allow our listeners to understand. Basically, what you're saying is that most of the financial institution and investment institution that you work for, that are very professional, I guess they run a lot of money with a lot of funds. They are very short-term oriented, and they are very, would you say shallow in a way?
Well, I think shallow suggests that you know what you're doing and you know you're being shallow.
Mm.
I think most people in the industry have a narrow job that is, I want you to do more M&A deals in telecoms, or I want you to phone more clients as a stockbroker in the healthcare sector or something. And that's just their job.
Hmm.
They're not given the piece as part of the larger environment. And even people who've got asset allocation roles, with fund managers or CIOs, I'm afraid I think less so in the past, but I think now a lot of those people are super bright and super capable, but they are still part of a system. And I've written about this in a piece that's going to be published soon. Career risk and peer group pressure and short-term relative performance all play big roles in influencing those people. And because they think they're being very objective, but we saw this, in 99, we saw this in 2008, is that there's an awful lot of really, really clever people that came to exactly the same conclusion that ended up being wrong. Well, they can't have been thinking that independently then. So I don't think anyone's shallow. I just think they're all clever and working hard, but they're in a system and in the same Kool-Aid that says what's happening now, how can I make money tomorrow, not how can I make money on a 20-year view.
Well, first, I think that by the time we will air this episode, your piece on current markets will be published, so we can put it in the show notes for people to read, because I haven't
Correct.
read it yet, but I'm sure it's going to be an interesting read. But I think it's very interesting what you just said, that there are a lot of smart people, and because this is what was I was in the market in 2008, and I was completely amazed. But how come that all those very smart people, rich people with great degrees, a lot of knowledge and not a lot of money, a lot of prestige, did such dumb things that simply ruined the economy? I mean, how come so many people smart people, as you said, doing such stupid things, and the madness of the crowd? I don't know if you remember this book.
I know it very well, yeah.
So I mean, I was amazed by how come smart people can do stupid things. And I think that what you said about the ecosystem, that you're in your echo chamber and the system is directing you in certain direction to go to, and you just end up finding the same conclusion that in the end is not wrong. It's absolutely devastating.
Right. Yeah, no, absolutely right. And I, I've everyone sort of fates Buffett, and I've been to Omaha, I don't know, 7 or 8 times, and I've read everything they've ever written twice, But actually, the person that had the biggest effect on me is Charlie Munger, because the way that Charlie Munger talks about mental models, the way he talks about consistency bias, the way he talks about psychology and how we make terrible decisions in certain circumstances, have had profound effects on the way that I sort of conduct myself. And the way I invest, because I just think once you start to understand all those shortcuts, your job is, the sort of thinking fast and slow and all that sort of stuff, you start to go, well, hang on a minute, am I just being dragged along here? And I think, now is obviously a marvelous moment to talk about that because there's so much going on. Exactly. But yeah, I think those people had big influences on me, and I think they still do. And that whether I'm right to sort of stand back from the crowd, you hope that you're right longer term to do that. Being self-employed, being a big investor in my own fund, my wife and I own the business. We haven't got a private equity firm who own half telling us what to do. It does give us freedom. So it does mean that we can, whether we're successful or not, we can live an independent life and an independent process and hope that wins out. But yeah, you've still got to be right.
Yeah. Okay, so let's talk about that. Your fund, ever since your fund is from 2011, right? But it's a UCITS
2011
fund.
We started, yeah.
Yeah, but the UCITS is from 2021. And in the last almost 4 years, the last record that I have on your fact sheet is to end of May, you compounded 47.6%. This is in pounds, right?
That's correct, yeah.
For your investor net of fees. So Tell us your philosophy. After all that you've been through and all the mistakes you made and all the everything that you see and what not to do, give us your principle of what you should do.
Okay, so I'm a big investor in entrepreneurs, and we'll talk about that in a minute. But one of the things I've learned from all the entrepreneurs, I've also learned from myself, and that is most of the best entrepreneurs I know have a mentality of try stuff and keep what works. They don't have a great master plan. They just do stuff. So I don't know, Amazon launching a product or something, and if it works, well then do more of it. Okay. And actually, that's exactly the way I've gone about investing. Is I've done all sorts of things. I bought value shares. I bought stocks trading, discounts to cash. I did all sorts of things that we don't want to go through now. And some of them worked and some of them didn't. And I was better at some and better at others. But you learn, and then you get to a sort of a sweet spot and go, okay, well, what am I good at and what works? And what I've found is that what works is the best entrepreneurs beat non-entrepreneurial led companies. I don't think that's a controversial thing to say, but it is still an important fact. Okay. Also, the best business models, sustainable returns on capital over time, beat not so good business models. Okay. So if you can buy a business with a great sustainable competitive advantage, and we can talk about what I mean by that if you like, moat for short version, and you can buy it and it's run by a really brilliant, proven, innovative, forward-thinking entrepreneur, well, those are pretty two good, powerful factors. And if you can then hopefully try and buy those businesses when the stock market's looking the other way or doing something else, or there's an investment phase and the stock market hasn't really realized it's an investment phase, well, then you're buying a great business run by a brilliant entrepreneur and you're buying at a great price. And that's what we try and do. And I don't really care what geographies they're in. I don't care what sectors they're in. I don't care whether two of them end up being in the airline sector. I just want to own the best quality bottom-up stocks that fulfill those criteria with the best sort of risk-adjusted compounding in the future that I can. Okay. And that's what we do. Well, and it takes us to some unusual places.
Okay, we're going to talk about some companies of those, but these are very good criteria. But tell me, how many stocks do you own?
I think we own about 27 today or so. I mean, we generally, a UCITS fund means we have to have a certain amount of diversification. Well, I won't go through all the rules here, but you need sort of, you can't really have less than about 25. And we've generally probably got 28, 30 or so at most points in time. But our top holdings, I mean, our top 10 holdings are about 60% of our fund. So we have a 30 in total simplistically, and the top 10 is about 60%. So we like to bet big where we think we've got some conviction in the main holdings.
So if I were to summarize what you said, concentrated portfolio of businesses with great economic units, with great competitive advantage, and run by great managers at a reasonable or even good price.
A better summary than mine.
Very interesting. Okay. Give us some names that you like in your company, in your holding. I see on your fact sheet, we can see that your number one holding as for end of May was Block.
Yep.
And then Jet2, Wise, and New Holdings. I don't know what it is. Maybe you can share with us. So tell us, choose which one you want to dive into.
Yeah, so let's talk about New Holdings. So New Holdings, if you'd have said to me, we'd have had this call. Yeah, so we had this call. I will. We had this call 3 years ago. You'd have said to me, do you think you'll buy a Latin American finance company? I'd have said, no way. Not going to happen, Gilead. Not going to happen. Well, New Holdings is a digital bank in Brazil. Okay? And it's now 6% of our fund or whatever it is. Okay? So why have I gone like off-piste over here and suddenly bought a digital bank in Brazil? Because it looks like businesses that I have seen succeed. I'm slightly loath to say it, but it explains it well. It could well be, and in my mind has a good chance of being the Amazon of banking. Because it is very focused on customer service. It is very focused on lowest unit cost. It is very focused on giving the customer fantastic value for money. And as a consequence of which, its customers absolutely love it. And it's gone from startup to having 110 million customers, of which about 100 million are in Brazil, which means it's got something ridiculous like 60% market share of everyone in Brazil who's got a bank account with them. And that's from being a startup. And so they're doing something pretty special because they're not Wise, they're not Revolut, they're not just doing transactions. They are actually taking deposits and lending money. So they are building a proper banking, or have built a proper banking model.
What is different,
but they're doing it in a different way
than a regular bank?
So one of the things we look for is sort of proven business models that or routes that we've seen before. And one of the things that we like is stuff I've just mentioned, so customer centricity, lowest unit cost, and so on. But we really like a disruptor business model. I really like it when a business comes into a sector and says, yeah, you used to do it that way, we're going to do it this way, and this is cheaper, more efficient, better for the customer, and you're going to love it. That's what Ryanair did to British Airways and Lufthansa. It's what Netflix did to Blockbuster. And now we go, well, of course Netflix was going to succeed. Of course it was. Well, we didn't think that when we all walked down the store to hire from Blockbuster. And what New Holdings has done is basically taken the scale economy share business model, which is where I build scale in a business, and I give some of the economies of that scale back to you, my customer. And now that is a model that's really well developed by Costco, by Tesco, by Amazon, and so on. But it's not a model that's been used in financial services. Okay? And what New Holdings have done, and they did it in Brazil, and they've done it in Mexico, and they're doing it in Colombia, is New Holdings has basically gone, I only have a digital interface. I don't have branches. So my cost base is really low. My cost to serve you, the customer, is really low. Now, rather than just run the business with a nice fat margin, I will give some of that benefit to you, Mr. Customer, in lower fees, lower interest rates, or higher rates of deposit. So as an example, I think off the top of my head, it's changed a bit now, but I think the base rate in Mexico was about 9% not that long ago. When they set up in Mexico, they offered 12% on their deposits.
12%,
and the domestic banks were offering
3% more than the base rate.
Correct, and the domestic banks were offering. So, and the domestic banks were offering half. So let's say it was 8. The domestic banks were offering 4 because they were being lazy, and New Holdings offered 12.
But how did they fund the 12? What is the source of the 3?
So to start with, they're obviously losing money. Mm-hmm. Okay, so it's a subscriber acquisition cost. Mm-hmm. But in time, the 12% that I'm paying you for deposits, I might be lending out to someone else at 25 on a credit card. Mm-hmm. Okay, but what they did is they brought the deposits in by offering the 12. Then they said, we're never going to stay at 12 forever, but as our deposit base grows, we'll reduce the 12 down to maybe 9 or 8, but it will still be pretty significant in comparison to the interbank rate. And that is a point of significant difference. So they've gone from, say, 12 down to 8.
In Brazil, when they're more veteran, what is their rate on the deposits?
I haven't. It's a blend. I haven't got that in front of me, but it's still the same. So they are still basically offering premium rates on deposit and more credit acceptance to more people. Mm-hmm. And so there is complexity in that, because you can get things wrong, and if you get a credit cycle wrong and you lend to the wrong people at the wrong time, you lose a lot of money. But they've been doing it a long time, which is what's very appealing to me.
What's a long time?
And they've probably been going for 11 years or so, 10 years or so. And crucially, in Latin America, a lot happens in 11 years in Latin America. We only have one, recession in Europe or North America every 7 or 8 years. They have, crisis every 3. So there is no guarantee that these people won't make mistakes when it comes to credit and the credit pricing. But what they have done very successfully so far is taken this model of, I'm very efficient. I will give that efficiency to you, Mr. Customer, in better pricing. I'll give it to you in no quibble service and great add-ons. And as a consequence of which, we have a win-win-win situation, which is what Buffett tells us to look for. They have a lower unit cost. The customer gets products that are great value, i.e. higher rates of deposit are easier to understand and credit acceptance. The company, however, still makes high returns on equity. The company is making probably a 40% return on equity in Brazil because its cost base is so low. Okay, but crucially, the net promoter scores of the products and services that they offer are of the very highest level in both Brazil and in Mexico. Mm-hmm. So this is a company that's basically saying, here's a good product, here's good customer service on a low unit cost base. I make a great return on capital and you're delighted as a customer. Well, that's what Amazon did. And Amazon then grew and grew and grew and grew. So, you can sort of get a feel for why I got pretty excited about New Holdings. And the more work we've done, we've now owned it for maybe a couple of years, the more exciting we've got.
And what are the prices they are being traded?
In terms of multiples?
In any terms, multiples of book, multiple of earnings, of EBITDA.
Yeah, so it trades on multiples of earnings. I bought it.
Does it have earnings that it's profitable?
Absolutely, absolutely. Yeah. So I first bought it at maybe 8 or 9 euros. It's about 12 or so today. Interestingly, the earnings of the business have grown much faster than the share price in the time that I've owned it. So when I was first buying it, I was looking through and saying, right, well, the revenue they get per user today is a bit depressed. So as that matures, and there's a lot of data to show how it matures, if I adjust for that, then that means I thought I bought it on 16 times look-through earnings or something. Okay, mm-hmm. It's now on sort of 15 times headline earnings. Mm-hmm. Now, if you remember any one of these businesses, because you are taking on new customers the whole time, and this is the business growing 25% per annum, your new customer by definition is not spending as much as your customer that's a year old or 2 years old or 3 years old. So, if you adjust for that, which is not an outrageous adjustment, you can easily end up with you're buying this company on 12 or 13 times earnings today, which I think is nuts in comparison to the runway of growth that could be ahead of it.
Very interesting. It's being traded in Brazil?
It trades in NASDAQ, it's ADR listed. The interesting bit about this company is this is a $50 billion company.
Wow.
No one's heard of it. No one's heard of it because it's the Latin American analysts that cover it. This is a company that could change the face of banking. And I speak to people that invest in America and they've never heard of the company.
Yeah, I never heard about it until now before. It's amazing.
So out of interest, just to answer a question you've not asked rather, I get asked where I get my ideas from. This is a good example. I noticed that Buffett or Berkshire Hathaway had bought a small stake in New Holdings when it came to the market, which was about the price I bought it at. It then went up and back down again, so I bought it maybe 2 years later. But I knew nothing about it, and I thought, well, I'm not going to go and buy a Brazilian bank. I have no idea what that is. And then I was listening to a podcast on it, and I was on a long train journey, so I listened to like an hour's podcast on it, and I was like, wow, this is amazing. And some of the unit cost stuff and the products that the customers love, the scale economy shared, some of that came through in that podcast, and that's what set me off down a path of going, this could be an amazing company, and that's what started me off. But I did all my own work after then, but it was someone else, in that case Berkshire Hathaway, who bought a small stake in it, that brought it to my attention.
Very interesting. Very interesting. Now, another holdings that you have, Wise, that I like also very much, is now under pressure. For our listeners, we're going to say that there is an investigation open in Brussels about money laundering using their platforms, and the stock went down around 20 to 25% in the last few weeks.
Yep.
How do you cope with such situation?
Let's just talk about the psychology of your stocks going down separately to Wise. I think if you don't know what you own and you don't know why you own it, then you shouldn't be in the job in the first place. Time will tell whether my process outperforms over time or not. But either way, if you really don't think you know what you own and you can't contextualize some of what comes out of the blue, you shouldn't be in the job in the first place. So I think I know what we own, and I know why we own it, and I know why. We'll talk about it specifically in a minute. What's just happened, I don't think is super important long term. But unless you've got a framework to hang that on, every day is the most stressful day of your life because you're just getting shot in the foot every 5 minutes. So I think you've got to know what you own, and that's why I can't own 100 stocks. We've got 25 or 30, and they don't change very much. The business models are pretty consistent over time, so I don't need to do that much to stay on top of them. But it's still a lot of work to stay on top of them. Specifically to Wise, Wise, without going through the whole business model, is basically another digital bank, but it's a business that is predominantly, it is mostly about money transfer. And I think the interesting thing, I think most great businesses from a technology perspective often come out of North America or actually Israel. This is an interesting one that's come out of Europe, and the reason I think it has is because foreign exchange costs and the friction of foreign exchange to individuals and small businesses is very high in Europe or frankly anywhere in the world apart from North America, because obviously in North America everything happens in the dollar, so it's not that complex. But if I'm based in the UK and I get paid by someone in France and his cost of goods sold is from Israel or from North Africa, there's a lot of money that's lost in foreign exchange in the middle. And Wise have basically sort of solved that problem, and I think they've come up with a brilliant solution to that problem. But what that means is that they've got millions of people as customers logging into Wise all day, every day, transferring £100,000 here and €1 million there, and £10 to your aunt in Botswana or something. Keeping on top of that from a money laundering perspective is an unbelievably complicated and arduous thing to do. And in a way, I think people go, it's terrible. Wise has been accused of money laundering. Well, that's not quite right, actually. no, it's not right at all. There are people that are trying to launder money who have tried to use Wise to do so. And we're going to find out whether or not they have or they haven't used Wise. But there are people laundering money all over the world. They're all trying to use, proper networks so their money can be laundered effectively. But the job of the banks and the job of the financial services company, including Wise and you and Revolut and all the rest of them, is to stop and enforce that. So on the one hand, you go, well, that's terrible. It seems like a really risky thing that's going on. On the other hand, you have to bear in mind the barrier to entry of anyone else coming in. And so a lot of people are saying, oh, well, Bitcoin can do what Wise is doing, or stablecoin can do it. Well, yeah, but how is it on money laundering? How is it on processing X million transactions a minute? And people like Visa and MasterCard have the expertise of doing that. JP Morgan has the expertise. New Holdings has the expertise. Revolut, Wise. But then the list starts to drop off. And the reason why Wise is being investigated is because it processes so many transactions, and just a few get through the net, it has to answer to regulators. So I'm not dismissive of it, but I think it's part and parcel of building a trusted money network.
So do you increase your holding in this kind of situation?
I normally do. The reason I didn't is on UCITS rules. I can't be too concentrated, and so I bought my first Wise shares around the sort of £7 department, and I've added to them a couple of times at this sort of price. On this occasion, I couldn't because I was already too concentrated.
But you think it's an opportunity?
I do. Yeah, I think it's really. I think. And it's a really good example of when you say to people, I want to buy great business models run by great entrepreneurs, and I want to buy them at times of stress. Everyone sort of nods and agrees, but at the time of stress, they're all telling you why the business isn't, why you shouldn't invest in it. And you're like, well, you said you wanted this opportunity. Do you want it or don't you? So I think this is part of the game. Part of the game is if you don't know what you seek, you don't have the conviction when a moment of uncertainty comes along, and that's what this is.
Guy Spear, I'm sure you know him, is a very famous investor, and he wrote a letter lately because he's closing his fund during his health situation, unfortunately, but he gave there a great quote from Mike Tyson. It says, everybody has a plan until he get a punch in
the face.
Exactly.
Yeah,
so right. This is exactly the situation, because in theory, buying a great business like Wise, when nobody likes it, it's great theory. But right now, when you get headlines about money laundering and things, and the share prices drop 20%, I think you need to be John Templeton in order to buy it.
I think the other thing I'd say is I think during these periods of time, it's important not to have your head in the sand. So what was really important to me is when this came out, Wise put out an announcement, and they said something in the announcement that I already knew, but it was really important that they said it. And I thought, right, yeah, that's good. And lots of people said to me, oh, I didn't know that. And what they said in the announcement was, we'll cooperate fully. We totally want to make sure there's never any money laundering on our website, on our system whatsoever, and we'll cooperate, and et cetera, et cetera, et cetera. They said, however, 25% of all the people that work at Wise work in some shape or form in either anti-money laundering, compliance, or related functions. 1/4 of all the staff, that's what they do. And I found the same thing. So we find echoes in companies. We bought into Meta during the sort of metaverse investment period when the stock was sort of quite depressed. And Meta said exactly the same thing. So Meta there was a time when it was being criticized for allowing pornography or allowing hate speech or whatever else, all sorts of things that people were quite rightly criticizing Meta and Instagram for. And so at the time, everyone says, oh, it's a disaster, it'll be shut down and someone else will set up, and maybe TikTok's better or whatever else. But the bit that they missed is that Meta said, yeah, we agree, and that's why we're committing. It was literally tens of billions of dollars in order to try and police that, but they were doing it in 160 languages at the same time. Now, it's not the fact that that's a good expenditure or a bad expenditure. It's the fact that the next person that comes along that wants to set up another Wise or another Meta is going to find it a lot harder to do, because the compliance costs of being a Facebook, Instagram, or Wise or Revolut is actually much higher than you think it is. And so I think these things have a yin and a yang. There's the threat of the short-term relationship with the regulator you need to get right. And then there's the other side of it, which is actually this is a much more complex monopoly than people think, or quasi-monopoly than people think.
It shows you the moat.
Of course.
But, okay, so I want to take it from here to current affairs because, yeah, it's very easy to say and even to do, buy things that the market doesn't like. But
yep.
It also be very challenging to do so when all the stock market is being exploded. And your stocks that you understand deeply that there are great businesses with great leadership at a great price, and you'll see a great prospect for them for the future, but they're doing mediocre returns in the meanwhile, and everything else is being exploded. Intel is 7 times in 6 months. SanDisk is 10 times, and Micron is 10 times, and like you see such a big blow up in the markets. How do you handle the FOMO?
There's a research piece, I think, which by the time this podcast goes out, we'll have published, so you can refer to it. Where we write about this in quite a lot of detail, and the reason we do it in quite a lot of detail, and it's about 8 or 10 pages or so, is because this is quite complex.
And maybe it's a good opportunity to, sorry to interrupt you, to tell our listeners that, and we're going to put in the show notes, that you have a lot of research on the companies that you hold on your website, and it's free for everyone to read, and it's very recommended.
Absolutely
very
right.
great.
Absolutely right.
I read it a lot and enjoyed it very much.
Yeah, that's very kind of you. So I because I used to be a researcher, I quite enjoy writing, and I find it a way of sort of clarifying my thinking. And so quite a lot of the research on the companies we've got is on the website, and then there's previous pieces we've written on macro, and I don't tend to write macro pieces just sort of for the sake of it, like on once a year or something. I tend to write them when I think there's something going on that I feel very differently to the stock market. So I wrote quite a lot of stuff in 07, 08 around a credit crunch that may or may not transpire and how bad it might be. And, some of that was good fortune. And now I'm writing about the capital cycle, which is AI, which is the sort of moment in time we're at with what's going on with the stock market and how the stock market is sort of responding to the opportunity that's AI. So would you like me to just outline that a little bit of where we are today?
I'd like very much for you to do
it. So what I think there's something that is worth people bearing in mind is that scientists study technological advancements, economists study economies, strategists study the stock market, but nobody studies all of it. Mm-hmm. And this is where Munger was brilliant. Munger talked about multidisciplinary thinking. And what a capital cycle is, which is what our research piece talks about, is it is a study of exactly that. And I've not invented it. In the research piece, there's 5 or 6 books that I've read on the subject that are equally or more brilliant than my summation. But the point being is that we've seen this a few times in history, not many, but a few. And we saw it in 99, 2000. And I didn't think that last year the stock market looked like 99. I think a lot of people said that, and I think they were a bit early. I think now it sort of does. And the reason for that is there's a few giveaways. One is the fact that the stock market is dispersion of returns is so great. So we've got haves, Intel up 7 times.
Explain. What do you mean when you talk about dispersion?
As in, we've got Intel up 7 times in a year. We've got Micron up 10 times in a year. And we've got Accenture down 70%. We've got Adobe down 70%. So that is a really unusual sort of really, really extreme levels of dispersion. And that doesn't usually go on for that long. So it's going to be really interesting to see how that pans out. So as I said, not many people study technology, markets, and economies altogether. And that's because most of the time they don't matter to each other. They exist separately from each other. So what NASA's doing and sending a man to the moon doesn't really have much effect on interest rates and house prices and all the rest of it. except at times like this. And at a time like this, what we have is a new technology. It's very similar in 99 with mobile phones and broadband and all the rest of it. And the new technology has got a group of people who are very sponsoring of it and very excited about it. And they were like that 2 or 3 years ago. And now we're all catching up. And the stock market, when it sees something like this, sometimes then just goes full throttle. And it throws as much capital as it can possibly muster at this opportunity. And in one of my pieces, there's a quote from Seth Klarman, who's a brilliant, obviously, hedge fund investor. And Klarman basically says, this just keeps going until it stops, on the basis that the market never stops. It expands infinitely until the bubble bursts. And so what is quite interesting is I think AI is a very interesting technology. I think it's very useful. I think it will be the benefit of productivity and to human civilization. But that doesn't mean that I think every AI stock in the stock market today is an investment. In fact, I think most of them probably aren't. And that's the difference, is if you go back to, say, 1999, 2000, 2003, 2004, 2006, were the periods of time when maybe you bought Google or Amazon or Facebook if you were smart. But those companies didn't even exist in 1998. Or Amazon did, but they weren't quoted, certainly. And in the research piece, we've shown the top stocks in the US and in the UK stock market, as they were in the peak of the market in March 2000. And some of them will make your eyes water. They don't even exist anymore. And so I think this is a very different period of time where capital is chasing an idea, and it is not being too picky about what the return on capital is. And that's not what great investors do.
Well, I'm sorry to interrupt you again, but I want to highlight it because it is a very important sentence for people to understand. You said that investors put a lot of money, and companies put a lot of money into an idea and then don't care about the return on capital. Right? Am I quoting you correctly?
Well, they should care, but they're too busy.
What they're doing, they're like says it will come.
The normal course of events is that the decision of capital commitment by a company, capital raising, prospectuses, meeting investors, is a careful, considered process whereby, well, are you sure? How are you going to spend it? And are you quite sure about that? And how's that going to work? And it's a toing and froing of everyone trying to work out if this idea is actually good or not. At times like this, that's not what people do. At times like this, the bankers are so delighted to earn the fees. The companies themselves are so excited to be growing and know they need capital. And right now they can get capital. I won't read the quote now, but there's a quote in one of the pieces, which is from Peter Thiel of PayPal fame and of Founders Fund fame. And it's basically him saying what happened around the time of the dot-com boom. And he basically says, PayPal was doing pretty well, but the New York Times wrote an article that basically said, it's growing like this and it's probably worth 500 million. He said, we raised money 2 weeks later, and the main investor we took money from used the Wall Street Journal article as fact or implied fact about what the value of the company was, and we got $100 million. And he goes on to say that if we hadn't got $100 million, we wouldn't be able to fund PayPal going forwards. So all these people are that are going through now are sort of the babies of Peter Thiel, and they all know that they need the money. And when the ducks quack, you feed them. And right now the ducks are quacking, and they're like saying, let's raise as much capital as we can. Now, that doesn't mean the cycle turns tomorrow, but it does mean that we've got a not terribly disciplined capital deployment process going on.
Okay, but I want to ask you a question. You own about 5% of your fund in Amazon. Amazon is one of the biggest spender of this time on infrastructure. How do you reconcile those two facts?
Yeah, I think so. What I'm trying to, I'm actually a big bull of AI. So I'm not trying to say that AI is a bad thing. I'm just trying to say we just need to think about who's going to benefit and who's not going to benefit, and which businesses are proven and which businesses are not proven. So I think there's a lot of companies which are generally network businesses that have already got powerful established networks, whether it be Wise or New Holding or Amazon or Facebook or so on, who will be able to use Wise not only for their own efficiency, but also to sell more products and services to their customers. And Amazon's recent letter from Andy Jassy made that very clear. It said that the demand from our
So basically what you're saying, sorry, uh, so why don't you hold Alphabet, Google? Have you considered it? But basically what you're saying is that Google uses its power to extract too much money out of their customers instead of giving it enough back to it. Very, very interesting. So how do you deal with the FOMO? I haven't understand yet. When you see the market goes so high. No, but you do report to your clients and you said, okay, in the last year, my fund returned 6% while the general stock by benchmark did 23. And you need to live with it and explain to that. And how do you cope with it? Mhm. Okay, so just to wrap up this point about the current market situation. So, where do we think do we go? What is the give us the conclusion from your paper that will be published tomorrow? Mhm. So, if I need to sum up, if if I need to sum up your answer, it basically says, well, there's a good chance there's going to be a crash. We definitely don't know where. And you can't be outside of the market completely and trying to time it. But the best thing you think is should do is just buy good companies with great leaders at a reasonable prices and let them do the work. Hmm. 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 Very interesting. Very interesting. Uh, Andrew, thank you very, very much for your time. It was very, very interesting. And I do encourage all you listening to go on. We put a link in the show notes to your website and to your research. and to subscribe to your newsletter, because I think you produce very, very interesting and high quality material. So thank you very much for your time. Enjoy. Bye-bye.